Welcome to Wealth Roadmap with Jeff and Steve, your guide to simplifying wealth management. Join us as we explore financial planning, taxes, investments, insurance, and legal frameworks to help you secure your financial future. Hello, everyone. Welcome to episode 2 of our podcast, Wealth Roadmap with Jeff and Steve. Steve, anything to say?
We made it.
We made it.
We made it to episode 2.
Episode 2. We're here,
Thank
guys.
you. Thank you for all the listeners who've been eagerly awaiting this next moment.
So today we're going to talk a lot about taxes. We kind of alluded to this in episode 1. If you listen to episode 1 about having a financial plan, or any plan for that matter. So today we're going to talk about taxes. It's obviously around the form of investments and things like that. And the biggest thing with taxes is what we always say to people, it's not about what you earn in your portfolio, it's about what you keep. And today we're going to go over the different impacts that taxes can have on your portfolio, depending on how it's invested. So I'm going to turn it over to Steve to kind of break down the 3 buckets of how your portfolio can kind of be managed when it comes to taxes. So take it away, Steve.
Yeah. So, not only is it about, keeping what you earn. Jeff, what was it that you said exactly?
It's not about what you earn, it's about what you keep.
Exactly. It's important because we have to understand that not all money is taxed the same. Right? So we live in a dynamic pay-as-you-go tax system where the more money that you earn, the more tax you have to pay. And so when we kind of break it down, we look at leveraging the order of money. We look at tax efficient funnels to help us leverage the order of money to help us increase our cash flow and really to ultimately be able to be in control of the taxes that we have to pay. So when we talk about tax efficient funnels, we usually talk about 3 different types of funnels. We have the pre-tax funnel, the post-tax funnel, and the tax advantage funnel. So the pre-tax funnel, these are things that you're probably very aware of, right? These are your 401ks or 403bs, any type of retirement accounts, your IRAs, pensions. So these are contributions made with pre-tax dollars. But then when you take money out of those accounts eventually, and there's rules around kind of when you can take that money out, those distributions are taxed as income. It's like earning a paycheck. Taxed as ordinary income. And then in that, all the way, I'll say that's kind of, if you can think of it as a 3 funnel picture, that's the funnel all the way on the left. Look at the funnel all the way on the right, the tax advantage funnel. And these are contributions made with pre-tax or after-tax dollars in a sense, where you are able to pay the tax on it today. But what happens is, you get tax-deferred, tax-free growth. And so depending on these types of accounts, these could be Roth IRAs, these are FSAs, HSAs, 529 plans, cash value life insurance. You get the ability to really ultimately eliminate Uncle Sam or the IRS from your money. As time goes on, these accounts grow, they grow tax-deferred, and upon distribution, they're tax-free. And so that middle funnel, the post-tax funnel, those are contributions made with after-tax dollars. And these are things like the brokerage accounts, your bank accounts, your real estate. So you pay tax on the dollars, then you put the money into these accounts. But what happens is each year they're taxed, right? So think of your savings accounts, for example. In the past, interest rates were so low that it really didn't move the needle much. But now as interest rates are climbing and we can see 4 or 5%, you'll start to see the impact of that interest income and how that flows to your tax return and how that interest income, and we'll get to this, but is taxed at your highest marginal rate. And that's key to remember. So ultimately, you want to have the right mix of accounts within each type of funnel. And you want the right mix in the accumulation phase as you're saving. You want the right mix into the preservation phase and then into the distribution phase, right? And that's distribution to yourself and even upon your passing. Right? We always say that there's a order of money that we need to leverage in that accumulation phase. There's a different order of money that we need to leverage in the distribution phase. And then also, upon your passing, as pass the money on and your beneficiaries inherit money, there's an order of money to help increase that cash flow that you really want in that phase as well. So the pre-tax funnel, a lot of times what we find is most people are saving into that pre-tax funnel. Now the issue becomes is that, well, if we have too much money into these pre-tax funnels, into these types of accounts, 401ks, IRAs, 403bs, what happens? A lot of the income when you pull it out is going to be taxed. And so, the question is, do we feel taxes are going to be higher or lower? So Jeff, when we look at that and we talk about that for the pre-tax funnel, now we have also the middle, right? So the left funnel is the pre-tax, that's taxed as ordinary income. The middle is the post-tax, and that's taxed more so, Jeff. I believe it's two different ways, right?
Yeah, so like, with your post-tax account, right? So money that maybe you already got out of your paycheck and, again, like Steve mentioned, maybe you put it in a CD. A CD is a good way to kind of illustrate this. If you put in $100,000 into a CD and it gets a 5% interest rate now with today's interest rate environment, you're getting a $5,000 1099 at the end of the year, right? You earn that interest, so you get that 1099. And so now if you're working, that 5,000 is just getting added on top of your current income. So depending on what tax bracket you're in, right, that's just getting added to your income. Whereas if I got that same $100,000, right, I paid my taxes on it, from my paycheck, and now I say wanted to invest it in Apple stock. Well, if I invested in Apple stock, and I don't sell out in the first year, now if eventually when I do cash out and sell out, I'll be paying long-term capital gains, which are a lot lower in today's tax environment than ordinary income. Now, if you again put that $100,000 into a CD and you reinvested the interest, it doesn't matter. You're still getting that 1099. So whether you use that $5,000 interest that you got from the CD or don't, again, you're getting that income, or you're getting that 1099, and you're paying taxes on it that year. Whereas, again, if you're able to utilize it into a brokerage account or ETFs or stocks, you could find yourself in a better, more tax efficient situation, down the road, long term, right?
Yeah. No, exactly. So it's like, just to break down, you have that pre-tax funnel. Again, think of three funnels. You have the left funnel, the pre-tax funnel. That's taxed at ordinary income rates. Done. We know that.
Eventually, right? Yeah, eventually
Eventually.
when we
Good
when
point.
we well, yeah when we pull the money out. Yep.
Yep. Yep. Great. Exactly. Nothing we can do about that. Right? It's ordinary income. That middle
Yeah,
funnel
and
post-tax. Go ahead, Jeff.
yeah, I was gonna say, and people are saying, oh well, why would I put money into my 401k or into an IRA? Well, yeah, eventually you're gonna have to pay money, or you're gonna pay ordinary income on that money when you pull it out, but you also got a deduction against your ordinary income when you put it in,
Right.
right? So all these different tax funnels that we're kind of talking about, the registration on your investment account, there's pros and cons to all of them, right? So if I have $100,000 of income, that's my salary, and I'm putting $20,000 a year into my 401k, when I go to file taxes, I'm only paying taxes on $80,000, right? I got that deduction. So that $20,000, yeah, it saved me money, right? So depending on my tax rate, I'm not paying taxes on that. So yeah, eventually when that $20,000 grows with the market and I retire, yeah, I'm gonna have to pay ordinary income. Whereas if I put money into a Roth IRA or cash value life insurance or brokerage account, I'm not getting that deduction. So remember that there's, pros and cons with all of these. Another thing that I wanted to point out is we're just talking about your registration, right? How the IRS views whatever your portfolio is and how it's going to be taxed. So for example, if you wanted to invest in Apple stock or Microsoft or a certain mutual fund or ETF, you could do so in all of these different accounts. But in terms of what you're going to be paying in taxes on the gains and everything like that, that's what's going to, you know, put you in a different situation within each, right? So again, I can invest in Apple stock with my 401k, my Roth IRA, and again, if Apple stock grows by 10% each year, I'm going to see that. But in terms of what the IRS is going to mandate that I pay taxes is going to be dependent on the type of account it is. Like Steve mentioned, if it's a 401k, a post-tax account, or a Roth IRA. But you know, and again, while they all have their benefits, Steve talked to us kind of about what you know, the I don't know what you want to call it, the issue with the 401k is when it comes to
Yeah.
obviously Uncle Sam.
Right. Yeah. No, and maybe not an issue. It's more, and this is what we talk about right often, and maybe we'll spend some other time talking more about this. But to your point about, you're getting if you save into the 401k, you're getting a deduction today, but yes, you have to pay tax later. This is why we're not saying that the pre-tax, the post-tax, um, or the after-tax or the tax advantage funnel. There's not one magic or one silver bullet, right? If that's the term to use. It's really figuring out the right mix, and it's managing and monitoring your um, individual tax brackets each and every year to optimize and to be able to incorporate tax management strategies into all of your financial and retirement planning decisions. So coming back to that, the funnels, you got the ordinary income with the 401k, you have capital gains or ordinary income, and that could be long-term or short-term capital gains or ordinary income you're taxed on in that post-tax. And then, of course, the tax advantage, tax-free. So coming back to the 401k, the analogy that I like to use is if you think about it, um, imagine you're getting into a business with somebody, and that person says, "All right, well, I have the ability to decide my ownership percentage based on however, whenever I feel. If I decide and I wake up tomorrow and say, I want more of my share, you have to agree to it. No ifs, ands, or buts. Would you sign that agreement? Obviously not, right? Like that, no, of course not. But if really any type of pre-tax account is like a partnership with Uncle Sam. Whatever Uncle Sam, by Uncle Sam I mean the IRS, whatever the IRS says, we pretty much have to do. All right. Yeah, there's different ways that we could get around certain things legally, but at the end of the day, there's avoidable taxes and unavoidable taxes. And so what we do know is, especially, when you kind of look at the future and you see, this large national debt, you see this large deficit. Two of the largest budget items are Medicare, Medicaid, Social Security. There's really two ways that we're going to be able that the government's going to be able to fix this problem. It's either reduce spending or it's increase income. And reducing spending, a lot of people just laugh. And like I said, two of the largest budget items are Medicare, Medicaid, Social Security. So, I'm not one to predict what they're going to do, but the only other option is to increase income, and the way they do that is by increasing taxes. So you really want to look at your situation, like Jeff mentioned. Does it make sense to take deductions now? Or is your income, are you a higher earner? Should you maybe do a blend? Take some of the distribution now. Take if you have the option to put into a Roth 401k or a Roth IRA. Do you do that instead? Every decision that you make should be really looked at not only from an investment or planning perspective, but you really have to layer in the tax management, and that's, I think, one of the areas that sometimes gets overlooked.
Yeah, I mean, obviously I get the deduction now with putting money into my 401k, but the issue is that, all right, well, if I, when I retire, let's say whether it's in 10 years, 20 years, 30 years, um, when I go to pull that money out, I don't know where tax rates are going to be, right? So yeah, my hand is kind of twisted there where I'm gonna have to pull money out and yeah, I'll just pay whatever the tax rates are at that time. And that's what makes, planning so difficult is because no one knows what tax rates are going to be like. So, if you told me, hey, these are the tax rates in 20, 30 years, all right, great. I could tell you exactly, how much money we should put into a Roth, how much money we should put into a post-tax, into a traditional, right? But yeah, we're basically kind of going off what, Steve mentioned, like, all right, do we think we're in a low tax environment? And all the data kind of suggests that we are. So, right now, does it make more sense for me to, look at putting more money in, pre-tax or just, like you said, Steve, kind of diversifying. But,
Yeah.
and even if I don't need that money, right, in retirement. If I, have enough money in cash, people forget that, required minimum distributions are a thing where the government says, hey, you know what, Steve, you put all that money into your 401k, you're now, 72, 73, 75. Again, that RMD age kind of keeps getting pushed back. But for most people, it's between 72 and 75. So at 75, the latest, they're going to say, hey, start taking out your money because they want their tax revenue, right? Steve, over the course of his working career, put a bunch of money in there, didn't pay taxes, and now they're saying, hey, we want our tax revenue from that money you've been kind of, sheltering. So, um, even if you're not going to need the money, eventually the government's going to kind of force you to pull money out at whatever tax rates they decide in that at that future time.
And they
Yeah.
want their money.
Yeah. So and with your pre-tax accounts, right, your IRAs or 401ks, it's in a wrapper. And what I mean by that is, if you have a 401k or retirement account, an IRA, and you have a portfolio that's creating interest like a CD, right? It's creating interest every year or it's creating dividends. It's all doing so within that wrapper, so it doesn't really matter. It's you're not going to get taxed on anything until you actually take the money out. But like we mentioned before, if you have a post-tax account, right, and you've already paid taxes on it, that's where your interest, your dividends, capital gains, it can fluctuate. So Steve, tell us about, the difference kind of between interest income and, dividend income with a post-tax brokerage account.
Yeah, yeah. And I think that's some call it fascinating, some just call it ridiculously confusing. Um, but that's what's so whatever you want, whatever adjective that you want to place there. Um, that's what's so wonderful about the IRS. They don't make it always easy to understand. It can be sometimes complicated, and a little bit confusing because you have ordinary income. Okay, great. That's taxed at kind of one level. Then you have interest income, and well, how's that taxed, right? Then you have dividend income. Okay, well, dividend income, is it a qualified dividend or is it an ordinary dividend? Because depending on what type of dividend it is, it's going to get taxed differently. And then, of course, right, as you mentioned, the capital gains, long term, short term, those are taxed differently. So let's start with the interest income. And I mentioned this earlier. Just keep this in mind. Just interest income is taxed at your highest marginal tax rate. Okay, so when you think of our kind of our income tax rates, they start at a certain amount. There's a standard deduction, and then currently in today's world, and we know that this could change in 2026. If Congress does nothing, taxes go up. That's what we know. It's fact. If Congress does nothing, tax rates do go up. But let's just say you're a married filing jointly couple, you're earning 250,000. All right. You're not actually getting taxed, and that falls within the 24% bracket. You're not actually getting taxed at 24% on that full amount of 250,000. It starts with, first you get the standard deduction. Okay, you got the standard deduction. Great. After that, what happens? Well, then you're in the 10% bracket. So the first $23,200 in 2024 gets taxed at the 10% bracket. Then the overage gets taxed at 12%. Then the overage at 22, 24, 32, 35, 37, so forth. So, and then of course you have the capital gains rate, but let's just focus on that ordinary income. So, if you're earning, a 5% rate, interest rate, what happens? Well, if you're earning 250,000, if your income's 250,000, and let's just say you have $100,000 in the bank, right? 5% of 100,000, $5,000. I'm making numbers easy here. Your income is not 250. It's what? It's 255,000. So that $5,000 is going to be taxed at that highest marginal bracket. So at 250, you're at 24%. At 400,000, that 5% would be taxed at 32%. So while these interest rates are very healthy right now, we have to really look at the full picture because you have to be cautious. Does it make sense to potentially position a different strategy to be able to possibly look at strategies that maybe produce capital gains, long-term capital gains, or possibly some strategies that provide tax-free interest, and maybe you're not getting a 5% return. Maybe it's a little lower, but that after-tax return could be the same, if not a little bit more, depending on your situation. That's why it's crucial to, when you're looking at where to invest and where to put your money, not only in the pre-tax money, but you got to look at the post-tax, and you got to look at that after tax because or the tax advantage, I should say, just because of how of the interaction between all these different types of gains or income are taxed. Now, dividend income, this is a fun one. It could be taxed as a qualified dividend or a non-qualified or an ordinary dividend. And to be qualified, so there's a couple characteristics here, and I don't want to get too deep into the weeds here, but basically to be a qualified dividend, payout must be made by a U.S. company or a foreign company that trades in the U.S. or has a tax treaty with the U.S. So that part's fairly simple to understand. The next requirement gets a little tricky, and really it has to do with the holding period, and you have to hold it for a certain amount of days um, before the ex dividend date. And again, we could certainly get more detailed about that. But just to kind of give you a quick understanding, just think of it like this: if you've held the stock for a few months, you're likely going to get the qualified rate. Now, if you haven't, you're probably not, or at least not yet. Um, with qualified dividends, certain stocks don't make the cut, right? Real estate investment trust, REITs, REIT, and master limited partnerships, they typically do not pay qualified dividends. So have to be careful about that. Money market funds and other, bond-like type instruments, they generally, okay, pay ordinary dividends. So dividends paid out as an ordinary dividend is now taxed at ordinary income rates. A qualified dividend gets the same type of treatment that a long-term capital gain tax or long time gets the same type of tax that you would get if you had a long-term capital gain. So it's a more preferred tax because you get into those brackets of 0, 15% or 20%, and yes, depending on that the surcharge, and there's other taxes that could add to that 20% capital gain tax. But
Yeah, the tax capital gain rates right now have been historically always lower than ordinary income.
bingo. Then that's the key,
So
right? Yeah. So qualified dividend, long-term capital gains, preferred tax. Interest income, ordinary dividend gets taxed at ordinary income rates, higher tax.
and touching base off like what Steve just mentioned right before about kind of like how we started the show is it's not about what you earn, right? It's what you keep. So yeah, if you're going to earn a 5%, but then you're getting taxed at 24 or 30% on that, what did you really keep? Whereas if
Yeah.
get a properly structured portfolio and you actually get 4% and you keep the 4%, well, yeah, I'd rather have that. So, again, that's why we're not always trying to chase um, the highest rate. Again, it's what you keep. So when it comes to again, creating that portfolio. So like you mentioned, Steve, if someone has 100,000 and, they want that CD or they want that fixed rate of getting 5%, um, do you want to go over the case study with Amy, and obviously Amy's not a real name, but we changed her name, about how, she came in and her portfolio, she did a great job saving. She had some money pre-tax,
Yeah.
right, in an IRA, but then she had some money post-tax. And I've seen this with a few different people, and it's not, people without advisors. It's people, unfortunately, with advisors that are not very keen to the tax sensitivity, within a portfolio. But
Yeah.
Amy came into our office, and Steve, so she had roughly $1 million. We're going to
Right.
use easy numbers for people at
Yeah.
home. She had $1 million in her pre-tax IRA account, and then she had $1 million in her post-tax account. Talk to us about what she was doing wrong.
Yeah, and I think you hit the nail on the head. This is one of the areas that when we review portfolios, we see this often, and what happens is they don't really have a tax sensitive asset allocation, and so what was happening was she went through the process with us, and we incorporated whenever we do any type of planning, we always request the tax returns because it's a window into really to help us understand exactly what's going on and what taxes are being paid based on the decisions and the types of investments that they have. So in this example, as Jeff mentioned, $1 million in the pre-tax, $1 million in the post-tax, $2 million total. And what was happening was she was getting a lot of income that was flowing to the tax return and was hitting that front page of her tax return. And she was like, it's eating into my returns. I'm having to pay this. What's going on? Well, what we did was when we looked at it, we said, okay, well, the way that she was a 50-50, she was a moderate, oh, I'm sorry, she was a balanced investor. She had 50% in stocks, equities, and 50% in bonds or fixed income. And she had that for each type of account, right? So in her pre-tax account, she was 50-50, 50-50, 50 stocks, 50 bonds, post-tax, 50 stocks, 50 bonds. But after we started to look at that, what we said is, well, listen, um, instead of holding all of the I'm sorry, instead of having a split between the two accounts, let's take all of the bonds, right? Because most bonds are taxed at ordinary, it's interest income, so it's taxed at ordinary interest. Let's hold that in the pre-tax account. Remember that left, if you think of the funnels, the left funnel, that's the pre-tax account. What do we say? No matter what, that's taxed at ordinary income. So why don't we hold those bonds in the pre-tax account, and then in the post-tax account, let's hold the equity. So we put 100% of the bonds in a pre-tax, 100% of the stocks in our post-tax account, which get that tax preferred treatment, the capital gains treatment, assuming you hold them for longer than 1 year. And so we didn't change what she owned, right? We just changed where she owned it, because it's about having the right investments in the right accounts to grow under the right tax conditions. And going back to even, looking at the positions that she held, in this case, we didn't have to tweak much, but going back to that ordinary versus kind of qualified dividend, if you're seeing that you have a portfolio that your lower taxed qualified dividends are paid into your taxable account, and your higher taxed ordinary dividends are paid into your IRA, again, maybe swap that around, right? Because the IRA, everything is ordinary income. So by having the right investments in the right type of accounts to grow into the right tax conditions, you ultimately can improve your overall return, reduce the taxes that you have to pay, reduce some of those unavoidable taxes by pretty much doing what you were doing, but just having the right approach.
And so for Amy, right? So she still has the same $2 million portfolio. She still has the same, technically, if we're looking at her accounts holistically, she still has the same 50-50 breakdown, right? But like you said, the post-tax account now is all equities. The pre-tax retirement accounts is now all fixed income. Um, Steve, historically, quick answer, which usually performs a little bit better, equities or fixed income?
Equities.
Equities, right? So now again, obviously past performance is not indicative of future results, all those disclosures, but if I have one account which is going to be taxed at capital gains rates, which historically have been lower than the other account, which is ordinary income, wouldn't I want the account that Uncle Sam is going to take a smaller piece of to be the one that's growing? So if in 10 years, the account that's going to be the biggest is the one that I'm most likely going to be having a less of a taxable event on, right? As opposed to having my retirement account be the, best, performing asset when I have to share those gains with Uncle Sam. Um, and again, if we even fast forward even, further on, and let's pretend that, again, your portfolio with the equities does produce well, does perform well. Steve, talk to me about if I have any money left over and I leave it to my kids, how does that work between the two different accounts for someone like Amy in this situation where, again, let's pretend that she left behind, the stocks versus the fixed income.
Yep. Meaning, just to make sure I get this right, Jeff, the IRA or the pre-tax account versus the post-tax.
Yeah, so like, if in let's say 20 years Amy passes away, right? And
Yep.
now let's just make up random numbers that, she has 1.5 million now of fixed income, and now $2 million
Yeah.
of her post-tax account. Obviously the post-tax has some
Yeah,
special
exactly.
privileges.
Yeah, so as of right now, the beneficiaries, the heirs that inherit that, get a step up in basis, right? So, what does that mean? It means that that post-tax account, they don't have to pay tax based off of that step up in basis. So upon her death, that money goes to them, and they get that step up in basis. Whereas the pre-tax, or the retirement accounts, it's called, or qualified money, that gets taxed. And we'll probably do a separate um, a separate show on this one because this can get pretty detailed. But the bottom line is, as of right now, based off the Secure Act 1.0, if they are a designated beneficiary right, that is not an eligible designated beneficiary, so certain beneficiaries, including non-spouses, so for example, children, when they inherit that IRA, they have a 10-year window that they have to take the money out, and they have to take annual RMDs 1 through 9, from years 1 through 9, starting at the year after the death, and then empty it basically after 10 years. So you get 10 tax years, but you have to take a RMD, required minimum distribution, out each year, and then at that 10th year you got to pull all that out. So that could mean a lot more tax to the person who inherits it, if they are this type of beneficiary. And if they're in the higher earning years, that means that they could be vaulted up into that higher tax bracket and could see, easily 30 to 40+%, if not more, of that money lost through taxes.
Yeah. Um, yeah, I mean, I feel like this, case study that we're talking about now with Amy, where, again, she had, again, $1 million in her pre-tax, $1 million in her post-tax, and it being in that 50-50 portfolio. I feel like I've come across many other individuals, maybe they had Roth dollars and it was the same thing in their Roth portfolio. They had, 50-50 or a 60-40. And, we recommended, certain strategies to kind of do what Steve had mentioned, where, we're making sure that the accounts that are going to grow the best are the ones that are going to treat them better in the long run when it comes to taxes. So let's talk about trickle down effects, right? So yeah, maybe Amy doesn't come across an advisor. She, has, income coming in, everything like that. Talk to us about the different trickle down effects. I'll start with one. Uh, when people are entering retirement, they don't know about IRMAA. And IRMAA is it's not a TV show, it's not your aunt. IRMAA is basically a penalty or a surcharge that Social Security and Medicare basically add to your Medicare Part B premiums and your Part D premiums. So depending on how much money you're making, people don't know that your Medicare premiums can go up. So if you're making $500,000 worth of income or $300,000 worth of income, you're going to be paying a separate or a higher amount for your Medicare than someone who, for example, maybe only making 120,000. And that's important because it's a it's what do they call it, Steve? A stealth tax, right? You don't really see it, but again, it's not about what you earn, it's what you keep. So yeah, if all of a sudden you have these dividends coming in or you have this interest income and it's adding to your income and now you're paying higher in taxes, well, in retirement there's that stealth tax of all of a sudden Medicare and Part B and Part D, your prescription plan, charging extra. Again, it's the same coverage. It's the same coverage, but you're penalized for making too much income. And that's because again, you may not have a tax plan when it comes to withdrawing your money in retirement. So IRMAA is one. Steve, what's another kind of trickle down effect for someone that may not have a tax efficient, distribution plan in retirement?
Yeah, yeah. So, it's again, talking about how complex this tax code that we have can be. Once you start to get to that age where you're thinking about pulling Social Security and then decide to take Social Security, there's another kind of type of income gets thrown into the mix, and it's called provisional income. So, you know, going back to having those tax efficient funnels, having the right or leveraging those funnels in order to help increase your cash flow to be more in control, especially when you start to or you're approaching retirement. You want to be able to control how you're taxed, because with provisional income, the way that it gets calculated is, you take 50% of your Social Security benefit plus your ordinary income plus dividends and capital gains and plus your non-taxable interest. So certain types of interest that may not fall on your tax return that you're not taxed on does get added back to your provisional income. And then that number, if you're married filing jointly, if that number is below 32%, none of your Social Security gets taxed on a federal level. The state, it depends on what state that you live in. New Jersey, New York, where we're in New Jersey, and so they don't tax Social Security. But now on the federal level, if you're between 32,000 and 44,000 of provisional income, 50% of your Social Security is taxed. Above that is at 44,000 and above, 85% of your Social Security is taxed. And then once you start bringing in Social Security, it could also cause additional, taxes to be paid. So you really want to make sure that, especially when you enter this stage or this chapter of your life, that you don't start pulling money out just randomly, that you have a plan to be able to know how and when to distribute your assets in the most tax efficient way, so that, again, you can kind of keep more of what's taking a lifetime to put together.
Yeah, I feel like there's a lot of times people are just pulling out money willy-nilly and not really having a plan, and next thing you know that that maybe that $3,000 that they pull out all of a sudden puts them above that threshold like you just mentioned, and now all of a sudden Social Security is taxed, right? Or all of a sudden now they're paying higher amounts in capital gains rates. And again, if there's no plan, then how can they really know? And that's where putting in a plug for any financial advisor. Hopefully your financial advisor is showing you exactly what your plan is and what the tax effects are going to be. So we kind of covered a lot talking about taxes. 33 minutes, 35 minutes in. It's we didn't even really dive too deep into it, but what are some proactive steps that someone can kind of take following this podcast to make sure that they're in the right position, Steve?
Yeah. So first off, it depends on what stage you are in your kind of what we call the money cycle. So ultimately, you got to identify that first. The second thing is just keep in mind, in any type of investment, financial, retirement planning decision that you make, keep in mind the tax impact that these decisions can end up having, especially whether it's contributing to a pre-tax account or contributing to a tax advantage account, whether it's holding money in an interest-bearing account that spits out interest income, as we talked about. Now we're paying tax on ordinary income. Better understanding of where your marginal rate is and effective rate is as well. Especially if you're approaching retirement, making sure that you do have what we like to call it the tax efficient withdrawal strategy, because at that point you probably have saved and you have accumulated all these assets and you have different accounts and different funnels, so to speak, and maybe they're in different buckets, but there's no way to really coordinate everything. And so having not only the ability to try to coordinate those decisions, investment, insurance, withdrawal strategies, along with the tax side, it's important. And that's where, if you need additional help, reach out. There's somebody who can definitely help, whether, whoever it is, but it's something that you should definitely keep into consideration.
Yeah, I mean it's important not just to diversify amongst your portfolio, right? You don't want all of your money invested in Facebook stock and then all of a sudden MySpace makes a comeback and Facebook's gone, right? You want to have some diversification so that if in case one company does go out, you're protected. And that's within your portfolio, but you also want that tax diversification, right? So that in the event that we fast forward 20 years and all of a sudden they increase tax rates to 60%, you have the ability to pivot. But if all your money is in a pre-tax account and you can't pivot, and all of a sudden the government's telling you to take out RMDs, you're stuck, right? But if you diversify amongst your tax classes, right, or tax efficient funnels, you have some money in post-tax, Roth, brokerage, life insurance, HSAs, all these different things. You can kind of position yourself, for the most optimal retirement when it comes to avoiding the Uncle Sam, because Uncle Sam's not even invited to Thanksgiving yet. He's the one that we send the biggest gift card to every April.
Biggest
So
expense,
that
right?
Yeah, that's it. So that kind of wraps up episode 2. Steve, any last things to add before?
No, you listen. It's just if anything, just if you take anything from this, it's just ask the questions. So that you're equipped with the knowledge, to achieve that financial independence and live your best life.
That's what we want for all of the listeners, is for everyone to live their best life. Words of Steve and Benny. Everyone, have a fantastic rest of your week, and we'll see you on the next episode.
Yes, sir. All right, man.
Take it easy, guys.
Bye-bye.
Thank you for joining us. If you enjoyed our podcast, don't forget to like, subscribe, and leave a comment on topics you'd like for us to cover on future episodes. We'll see you soon.
Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. One Team Financial LLC and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through One Team Financial LLC are not affiliated with PCA. Information received from this video should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. Content may have been created by a third party and was not written or created by a PCA-affiliated advisor and does not represent the views and opinions of PCA or its subsidiaries. For information pertaining to the registration status of PCA, please contact the firm or refer to the Investment Advisor Public Disclosure website. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using contact information herein. Please read the disclosure statement carefully before you invest or send money.